Banks are very important in the global economy because they've been around since we started using money. We use banks to save extra money and to borrow money when we need it. Everything seems great, but did you know that banks keep many secrets from us? Welcome to MoneyWise, where we teach people about managing money, getting wealthy, and reaching financial freedom at a young age. In this video, we'll share some hidden secrets that bankers don't want to tell us because they benefit from us not knowing them. 1. Money in the bank makes you poor. We've all heard the saying that having money in the bank is like having a money tree in your backyard. While this saying is true in some ways, it doesn't tell the whole story. Keeping your money in a bank account is better than hiding it under your mattress. The main reason is that the bank pays you interest. So, we might think that our money in the bank will grow because of this interest, but that's not really the case. To understand this, we need to know about something called purchasing power parity. Back in the 1990s, you could buy a Big Mac from McDonald's for around $3. But today, the same Big Mac costs $5.80, which is almost double the price. So, the value of your $3 has gone down when it comes to buying things like burgers. This is what we call inflation, where everything becomes more expensive over time. Let's say inflation is around 4 to 5%. To maintain your buying power, the interest rate on your savings account should be at least the same as inflation. But you know that's not true because things like gas and milk have become more expensive. Plus, you've probably cut down on expenses over the years just to make ends meet. This shows that your money in the bank isn't growing at the same rate as inflation. On the surface, banks usually offer a 3% interest rate. However, when you consider that inflation is at 4%, you're actually losing 1% of your money's value each year by keeping it in the bank. So, leaving your money sitting in a bank isn't a good idea if you want to maintain your current lifestyle. Instead, a better approach is to invest your money in assets that tend to grow faster than inflation. Some good options include stocks, real estate, and even government bonds if you want safer investments. These can help you preserve and grow your wealth over time, even when prices are rising. 2. Debt is free money for the rich. Another reason why wealthy people borrowed money even when they had plenty of extra money is because taking on debt can provide several advantages. Let's continue with Mr. Zuckerberg's loan story to demonstrate how you can use debt to your advantage. As we all know, Zuckerberg had a net worth of $15.7 billion at that time, so he didn't really need that loan. However, there was a hidden truth behind his decision. He understood that by simply investing such money in an index fund that earns 8%, he could make nearly 7% in interest. This return was much higher than the 1.05% interest rate he had to pay to the bank for the loan. Furthermore, he used this loan to get tax benefits, which allowed him to save even more money by paying fewer taxes. So, if you are savvy with your debt, like Zuckerberg, you can easily turn your debt into extra cash. 3. Credit cards are a boon for banks. If you believe that bank representatives are your friends, it's essential to understand that this perception is mistaken. When bank salespeople approach you to sell a credit card or any other financial product, their primary concern is meeting their monthly sales targets. They often do not take into account your individual financial needs or circumstances. In fact, their friendliness might be a tactic to encourage you to sign up for their products. It's crucial to recognize such friendliness as a potential red flag. Credit cards are a significant source of profit for banks, but they can also have adverse consequences for you as a consumer. Let's delve into more details regarding why credit cards can be problematic. High interest rates. Credit cards typically come with some of the highest interest rates among all forms of debt. In some cases, these interest rates can reach up to 20% or more. If you consistently pay your credit card balances in full and do not carry a balance from month to month, you can avoid paying interest. Unfortunately, only a small percentage of cardholders fall into this category. As of 2023, a substantial number of Americans are burdened with a massive credit card debt of $986 billion. Additionally, 65% of credit card holders Do not pay off impulse spending. Credit cards can lead to impulsive spending behavior. The ease of swiping or using a card for purchases can disconnect consumers from the reality of their financial situation. Without the immediate exchange of physical cash, people may overspend without a clear plan for repaying their debt. This behavior can lead to a cycle of debt that is challenging to break free from. Interest rate increases. Banks can raise the interest rates on your credit card debt with just a 15 to 30-day notice. This can make it much more expensive to carry a balance on your card. Unfortunately, many cardholders don't carefully read the details in their bank documents or keep a close eye on their accounts. As a result, they might not realize when their interest rates go up, leading to more debt and financial difficulties. In short, while credit cards offer convenience and flexibility, they also come with significant financial risks. It's vital to use credit cards responsibly. Pay off your balances in full when you can, and be aware of the potential problems that come with using credit cards. This knowledge can help you make smarter financial choices and avoid unnecessary debt and financial stress. If you found this video helpful, please like and subscribe to the channel for more personal finance videos.